Hello students, welcome to the lecture on money management, and after this lecture we will be able to learn the following objectives. Discuss nutrition education, describe role and preparation of ORS, and explain nutrition education of members suffering from fever and diarrhea. Let's start with the concept of money management. Money management is the process of controlling money and wealth. There is no doubt that money management is an essential skill that one must pick up in life. Money is very important to anybody living in the modern world today. Many people would agree that it is almost impossible to survive and live normally without money. Whether one lives in a developed country or in underdeveloped country, one would have to deal with monetary issues very often. Hence, money is very important in the world today, no matter what we are. So teenagers and young adults should be educated on money management due to their general lack of experience and knowledge in this area. The term money management is usually used to refer to professionals who work for large companies. There is a wide range of money management available. Money management is also called investment management and or portfolio management, generally when referring to the professional management level. Let us now understand family income. Family income is total income earned by all family members who have been living in the household for at least 1 year and are at least 14 years old. The term income is broad, including income earned through employment, business, farming, rent, pensions, dividends, interest, social security, and other money income. The family income includes all the goods and services from various sources such as salaries of the members of the family, income from land or other immovable property owned by the family. Scholarships, gifts, etc. are also included in the total income of the family. Even money saved by the use of homegrown vegetables and other agricultural products will form part of the income of the family. Services such as rent, free houses, free servants, free transport, free medical facilities, etc. are also included in the total income of the family. Family income is divided into some types. Money income. This income flows into the family in the form of currency, bank draft or checks. Money income includes all the income received in the form of money like salary or wages, house rent, gifts, interest earned from bank deposit and other investment. Money is valued by individuals and families because of its purchasing power over goods and services like food, clothing, shelter, educational and medical expenses, etc., some of which are vital for the survival of human beings. Real income or non-money. It is defined as the flow of goods and services used or available for any given period of time. Real income is derived as a result of efforts put in by the members of the family without the use of money income. Facilities of a free furnished house, telephone at residence and car for private use provided by some employer are some good example of real income. The community provides another form of real income for family use through its public schools, library, park, markets, etc. The family that makes use of these facilities can increase real income considerably without expenditure of money. Psychic income. By the use of money, goods and services are obtained in order to fulfill the needs of the family members. Thus, it brings satisfaction to its family member, which is called psychic income. This is purely subjective in nature and cannot be measured. Psychic income is relative in nature but very important to realize in order to achieve the family goals. Direct income, it consists of those material, goods and services available to the family members without the use of money. Examples are vegetables, fruits and flowers from home garden as well as other services. These services include those of the homemakers who prepare food, cares for the family members, clean the house, the son who purchases things for the family, and the services of the daughter who help the mother in the household activities. Employment benefits offered by employers to employees such as free housing, medical aid, free education, schemes, loan facilities represent direct real income. Indirect income. Indirect real income consists of those goods and services available to the family involving the use or exchange of money. Budgeting. The common planning device for the use of the money is the budget. It is a carefully prepared spending planned based on the actually family income. It is a plan based on previous experience, present needs and future expectation. A budget is always prepared for a fixed period of time, generally for a month. Importance of budgeting. Budget acts as an intelligent guide to spending. It enables a family to have an overall view of the income. Budgeting facilitates adjusting irregular income to regular expenditure. Budgeting helps people to discuss their needs and set their own priorities on them. It helps one to cut unnecessary expenditure. It helps one to be free from debts. It helps one to live without one's income. It encourages conscious decision making, which may help in including long-term goals in the budget. It relieves the family members from worries of future. It forces one to decide what one wants most out of life. Budget is a guide to realistic spending aimed at avoiding over expenditure. Its success depends upon its being simple, realistic, flexible and suited to the family or individual for whom it is made. Control of the plan in action is impossible without a written plan. Steps in preparing the budget for a family. List commodities and services needed by the family members throughout the budget period. Estimate the cost of desired items. Total each classification and estimate the total for the budget. Past records are helpful in this connection. Bills, check, receipts, etc. Estimate and total expected income from all sources for the budget period. Set aside a definite sum as emergency fund as well as for goal-oriented savings and insurance. Bring expected income and expenditure in balance. Check the plan if it is realistic. List of budget items. It is necessary to list the chief budget items to make sure that each item is attended to in the expenditure plan while proportioning the income. Each family may have their own way of listing the items. The chief budget items are food. Food is the most important of all the items since it is a necessity. The quality and quantity of food available for the family affects their health, efficiency and happiness. Clothing. Only items bought from a shop are to be included. These may be garments, shoes or accessories needed by the family. Cost of fabric and tailoring charges may also figure in this group. Housing. This includes charges on a rented house, repair charges and maintenance charges paid by the tenant. This does not include sums paid towards the purchase of a house or plot, fixtures, electricity and water charges. Education. The educational expenditure depend upon the importance attached to education. All expenses incurred in connection with school or college education such as tuition fees, other fees, cost of notebooks, textbooks and stationery. Personal expenses, sundries. Purchase of toiletries, laundry and dry cleaning charges, cost of subscription to membership fees of clubs and association, purchase of gifts, expenses incurred on cultural and recreational activities. Medical bills may also be budgeted under this head. Household expenses. All the expenses for running the house, electricity, water, fuel, telephone bills, and wages of part-time and full-time helpers are included here. Savings. Money has to be set aside for investment, insurance premium, for chit funds and other schemes. Expenditure. Happiness of the family is secured by income used or expenditure. Expenditure provides the satisfaction of life for the members of the family. All expenditure for the household may be divided into needs and wants. The needs are those which are necessary for maintaining a healthy, efficient household, which a family must take care of, and there are emergencies and special demands arising occasionally. The regular monthly items of expenditure for most families include food, clothing, shelter, education, health, housekeeping, recreation. Part of the income may be set aside in the form of savings for special needs or emergencies such as marriage, education, pleasure trips, or sickness and old age. The various factors that affect one's expenditure are income of the family, size and composition of the family, age and occupation of the family members, education, location of the house, health status of the family members, interests and abilities of the members, the availability of the goods, price of goods, customs of the family, personal likes and dislikes, the general consumption pattern, saving pattern of the family in the future. Sources of family income. Household derive their incomes from three basic sources: from wages or salaries received in exchange for labor, from property like land, capital and so forth, and from government. Wages and salaries. About 60% of personal income in the United States in 2000 was received in the form of wages and salaries. As we saw in an earlier chapter, competitive market theory predicts that all factors of production are paid a return equal to their marginal revenue product, market value of what they produce at the margin. There are reasons why some types of labor may be more productive than others and why some households have higher incomes than others. Required skills, human capital and working conditions. One explanation for differing wages and salaries is that people have different marginal revenue products based on their skills, education, talents and background. The rewards of a skill that is in limited supply depend on the demand for that skill. For example, the salaries of male professional basketball players far exceed those of women players in the sport, but that is not true in tennis. Not all skills are inborn. Some people have invested in training and schooling to improve their knowledge and skills, and therein lies another source of inequality in wages. Multiple household incomes. Households also have different wages and salaries because some households have more wage earners than other households do. Roughly 60% of the women that are over 16 in the US were employed in the year 2000, and many married couples live in two incomes. As the number of single-income households changes, it could be expected that the distribution of wages and income will change. This explanation for differing wages also highlights a problem with using income distribution as a measure for equity. The minimum wage controversy. Many countries have used the minimum wage as a strategy for reducing wage inequity. In recent years, this has come under attack. Opponents argue that minimum wage legislation interferes with the smooth function of the labor market and creates unemployment. Proponents argue that it has been successful in raising the wages of the poorest workers and elevating poverty without creating much unemployment. Unemployment. When the economy goes through an economic downturn, people are unable to find jobs. For some workers, the cause of unemployment is reduced by unemployment compensation benefits paid out of a fund accumulated we receive from a tax on payrolls. Supplementing family income. Supplementing family income implies the additional earnings or income for the family apart from the regular family income. Money is not always available to a family in the same amount all the time. For a variety of reasons, the family may need to seek ways and means of obtaining additional income in order to make both ends meet. This need arises if the expenditure exceeds the total of the assured and probable income. There can be many factors which affect in earning the additional increase for the family. However, one need to consider the following points while preparing for supplementing family income in order to avoid any future problem. The availability of the time, space, energy and small amount of money to invest to earn more, availability of space, support and assistance of varied nature, unforeseen risk involved, one's own interests, education, abilities and skills to carry it out to earn more. Now moving on to the next topic, we will now study the household accounts. Money management, like other management processes, involves planning, controlling and evaluation. The main objective of money management is all-round development of the members of the family, enhancing their happiness and health by making best use of the income of the family. To achieve these goals, both husband and wife should prepare the family budget together, considering their source of income, expenditure and need for future savings for their families. Procedure of keeping household accounts. Household accounts can be maintained as per the personal choice of the household manager. Notebooks. In keeping household accounts, either bound or loose leaf notebooks may be used for keeping household accounts. Now we will discuss the saving. Savings are the means to an end. These are the difference between earnings and expenditure of the family, which is kept as saving for the future use. There are several reasons and need for saving. Some of them are foreseeable while others are not. The mostly common ways of family saving are as follows. Bank accounts. A bank does business by taking charge of people's money and lending it to those who need it. Post office saving account. As post offices are more in number and spread all over the country, they form convenient places for having saving accounts. Provident fund. This is an attractive method of saving for person in service. Chit funds. Chit funds have been a popular method of saving for a long time now. Life insurance. This is perhaps the most widely used method of saving, which as a result becomes an investment. Importance of saving. One of the most fundamental quests of life has been how to secure lives from its very uncertainties. Each one of us wants to live a beautiful and joyful life, but if we look around and find out, one fact comes out really strong, and that is one who is financially sound and secure is able to enjoy the sweet fruits of life and is able to live a wonderful life. Risk in investment. Risk is the uncertainty that one will receive the promised return. The greater the risk one takes with investment, higher the potential rate of return and the greater the chance that one might not receive that return. In other words, one is paid for the risk taken by him. Financial risk. The possibility that shareholders will lose money when they invest in a company that has debt if the company's cash flow provide inadequate to meet its financial obligation. When a company uses debt financing, its creditors will repay it before its shareholders if the company becomes insolvent. Financial risk also refers to the possibility of a corporation or government defaulting on its bonds, which would cause those bondholders to lose money. Investor can use a number of financial risk ratios to assess an investment's prospect. For example, the debt to capital ratio measures the proportion of debt used given the total capital structure of the company. A high proportion of debt indicates a risky investment. Another ratio, the capital expenditure ratio, divides cash flow from operators by capital expenditures to see how much money a company will have left to keep the business running after it services its debt. Market price risk, the possibility for an investor to experience losses due to factors that affect the overall performance of the financial markets. Market risk, also called systematic risk, cannot be eliminated through diversification, though it can be hedged against. The risk that a major natural disaster will cause a decline in the market as a whole is an example of market risk. Other sources of market risk include recession, political turmoil, changes in interest rates, and terrorist attacks. The two major categories of investment risk are market risk and specific risk. Specific risk, also called unsystematic risk, is tied directly to the performance of a particular security and can be protected against through investment diversification. One example of unsystematic risk is that a company whose stock owned will declare bankruptcy, thus making stock worthless. This is the risk that the price of an investment will go down. This rarely happens to money saved in a bank, savings and loan or credit union. However, the prices of stocks, bonds and mutual funds are determined by supply and demand, and they do go down as well as up. Liquidity risk, the risk stemming from the lack of marketability of an investment that cannot be bought or sold quickly enough to prevent or minimize a loss. Liquidity risk is typically reflected in unusually wide bid-ask spread or large price movement, especially to the downside. The rule of thumb is that the smaller the size of the security or its issuer, the larger the liquidity risk. Although liquidity risk is largely associated with micro cap and small cap stocks or securities, it can occasionally affect even the biggest stocks during the time of crisis. The aftermath of the 9/11 attacks and the 2007-8 global credit crisis are two relatively recent examples of times when liquidity risk rose to abnormally high levels. Rising liquidity risk often becomes a self-fulfilling prophecy, since panicky investors try to sell their holdings at any price, causing widening bid-ask spreads and large price declines, which further contribute to market illiquidity and so on. Let's know the meaning of investment. The word investment has become muddled with overuse. Referring to a stock or a bond as an investment is still in regular use, but now people make investment in their education, their cars and even their flat screen TVs. Types of investment: mutual funds. Mutual fund is an investment trust that collects money from investors having a common financial goal. Bank fixed deposit. Fixed deposit FD is a financial instrument where an investment is made for a fixed period of time, resulting in a higher rate of interest in return. National Savings Certificate NSC. Rate of interest is 8% per annum, compounded 6 monthly, but it is paid 6 monthly. Minimum limit is ₹100 and no maximum limit on investment. Public Provident Fund PPF. It is one of the instruments suitable for long-term investment. Now moving on to next topic, income tax. Annual charge levied on both earned income, wages, salaries, commission and unearned income, dividends, interest, rents. Let us discuss the types of income tax. Personal income tax. The best known income tax is the tax that is paid on personal income. Capital gains. Capital gains or losses are income or losses that one incurs from investment in property or goods.
Save tax with the help of tax saving schemes. Tax saving schemes entitle you to a reduction on your taxable income. What this means is that if you have a taxable salary of 9 lakh rupees and invest 1 lakh rupees in any of these tax saving schemes, then your taxable salary gets reduced and you pay tax as if you earned only 8 lakh rupees in the year. One must note that tax savings brings in financial planning. Also, tax planning should be linked to your financial goals. Do you know what components of insurance are eligible for tax rebates? Premium paid for health insurance falls under Section 80D. Hence, it becomes non-taxable. Premium paid for life insurance falls under Section 80C. Hence, it also is non-taxable. Even the returns from any of these investments are non-taxable under Section 1010D. So, why insurance for tax planning? A certain medical emergency or unfavorable incident can wreck your savings and financial plans. In such a scenario, a life insurance cover or health cover proves to be extremely beneficial. Do you know how much tax rebate can you avail through insurance premiums? Premium paid for health insurance of self, spouse and dependent children is eligible for tax rebate up to 15,000 rupees. Investment in health insurance for dependent parents is also eligible for tax rebate up to rupees 15,000. In case your parents fall under the senior citizen bracket, then their rebate gets increased to rupees 20,000. Similarly, you also get a rebate up to rupees 1 lakh on the premium paid for your life insurance. Thus, the total rebate on tax you can get through insurance is equal to 1,35,000 rupees. Now, let's analyze how much money can be saved through this rebate. Keeping average tax rate on savings at 30.9%, one can save up to 41,715 rupees.
Now in the end, let us summarize what we have learned in this lecture. Money management is the process of controlling money and wealth. Family income is total income earned by all family members who have been living in the household for at least 1 year and are at least 14 years old. Money management, like other management processes, involves planning, controlling and evaluation. The word investment has become muddled with overuse, referring to a stock or a bond as investment is still in regular use, but now people make investment in their education, their cars and even their flat screen TVs.